Hey guys, it's Dan here. In this week's episode, let's try to answer the question, how much money should a company raise when it's going public? To do so, of course, we will look at some goals and projections of the company because it's all related to the financing, right? And then, of course, the goals of the investors, and for sure, we will also have to talk about the phenomenon of dilution. All that being said, ladies and gentlemen, let's roll. Now let's start with the basics. What does it mean to go public in the first place? Well, as you probably know, each company starts as a private company. Let's imagine Uber, for example, 2009. Uber went public then 2019, I believe. So they were a private company, went public, and became a publicly traded company. So what is the difference? Well, the big difference is related to the investors which are behind them. As a private company, you usually belong either to the owner. Facebook is a good example with Mark Zuckerberg before they went public, or SpaceX, or Tesla with Elon Musk, for example. All these companies were private and became public afterwards. So behind them, when it was private, there was the owner, of course, and then there were always some kind of private funds behind, such as private equity funds, which are big private money funds that invest in private companies, and of course venture capitalists, who are kind of the kings of discovering early young startups and pushing them to becoming public to cash out afterwards. So what is the goal here? Well, the goal from usually one of these three or all of these three is to cash out at some point, meaning to sell their shares to public investors such as you and me, and of course all the big guys such as the big banks, the pension funds, the hedge funds, the asset managers such as BlackRock and all these companies. So as you can see, between private and public, at some point you go public, and there are different ways to go public. There are three ways of going public. First of all is the IPO, initial public offering. The second way is using a SPAC, which is a special acquisition vehicle. And the last one is direct listing. So I don't want to lose too much time on these three different things because I made a very special video about it. So if you want to know the pros and cons of these different forms of going public, make sure to check out this video in the link in the description below. So now that you know what a private company is and how it becomes public using, well, one of these three methods, the question is, well, how much money should they raise, and is there some kind of benchmark? And let's look at an example. Now let's look at an example to have a better understanding of why a company wants to go public and how much do they want to raise, because there are a few questions to be asked to have the right answer. So now let's dive into the example. Follow my hand because there is a lot on the screen, as you can see. So first of all, here is my private company, and the private company has decided through the board, through the investors, which are already existing, of course, that they want to go public, right? This is the goal of the company, and this is not something you do after dinner, after a few beers, of course. That's something, it's a long-term strategy that has to be decided by the board, and of course, it takes a long time to prepare all that stuff. So now imagine their goal here is to go public, everybody has agreed, and they hope to get $2 per share when they go public. So now, right now, what is the owner structure? How does it look like? Well, first of all, the original owner, so the entrepreneur, he still has 50% of the shares, and then you have some private equity investors who have 25%, and you have some venture capitalists who also have 25%. They all have agreed before they go public that the owner, the original owner, the entrepreneur, wants to keep all his shares. So at the moment he has 50 shares and he wants to keep all of them because he wants to keep 50% of the business and 50% of the voting rights. And the two others, the private equity company and the venture capitalist, well, they want to cash out and they want to sell at least some portion of their shares. So right now they both have 25 shares and they definitely want to sell a part of it because they want to cash out and put their money that they made into a new project, of course, because this is how private equity companies and venture capitalists work. That's their business model, actually. So now that we know all that, the big question every company has to ask itself when it comes to raising money for an IPO is, do we need more cash? That sounds like a stupid question, but I will show you in a minute why this is very fundamental, because actually there are two ways in an initial public offering that you can manage, and this has to be very clear at the beginning. So this question is very important. Do we need more cash? Because it will lead to different results. So how do you assess, how do you know if you need more cash? Well, first of all, of course, it depends on the cash generation of your business. If your name is Uber and you are burning 5 billion of cash because you are not a profitable business, well, that's a problem. That means you definitely need more cash, for sure. Then, of course, there is also financing, which plays a huge role. How much is already financed through banks, through bonds, and the financial markets and all these things? Can we get more money from them, or do we need to go to the stock market and sell some shares of ours to get more money inside? And then, of course, that's the big X factor, is the anticipated project cost. I give you an example. When Uber went public in 2019, they said, they could have said, of course, that would be a very bad story, a very bad pitch for the new investors. Well, our name is Uber, we are famous, we are burning 5 billion of cash, we need money, because this is really what the story was, technically. But of course, they played it very nicely. So what they said basically is, they said, yes, you're right, right now it's not a profitable business model, Uber is still burning a ton of money every year, but our goal is we want to raise more money because we need more to finance our autonomous driving fleet, because the goal, of course, is to get rid of the driver so you don't have to pay anybody, because the robot is not taking any money, of course. And once everything is autonomous, our business model becomes profitable. That was kind of the pitch to the new investors, and that's why they said they needed more money. Storytelling is very important, as you can see here. So Uber, for example, said, okay, we need more money. So the answer to this question was yes. So in this case, you can do what is called a first fresh issue to the public. If you don't need money, you can do an offer for sale, which basically means you are selling the existing shares. Usually it's a mix of both, but let's look at this example here, and you will see why it makes sense usually to take both of them. So in this case, the company has decided, well, we need $50, let's say, for a new, very important project. And this project is so important that they believe that the share price is now at $1, and when the company goes public, investors will pay $2. So basically the value of the company should double because of this anticipated project, which will be huge and game changer and all that stuff, okay? Imagine. So now what is happening, and now let's walk through the example. Here again, I'm saying my original owner has 50%. He wants to keep all his shares because, well, he's the original owner, he doesn't want to sell and all these things. And then the two other guys, the private equity and the venture capitalists, well, they want to sell. Right now, we know we need 50 to be financed through the IPO. That's what we want to raise. Okay, that's the money we want and we need. So the question is, they have decided to split it into fresh issue, meaning new shares issued in addition, and also offer for sale, which means they're also selling old shares. That means basically here my pie is made out of 100 shares. We said that the owner is not selling, so the two others will sell how much they can sell basically. And imagine they have agreed that out of the 25 they each have, they want to sell 10. Okay, so they basically get rid of half of the equity basically. Okay, so that means that the existing shares from these two guys, so the 25 and 25, they will sell 10 of each, okay? So in this case, for the offer for sale, they will sell old shares. And how much will they sell? Well, they have agreed to sell 10 and 10 to the new owners. So they will sell 20 shares in total at a price of $2, because imagine during the IPO, that's what came out, that it's going to be $2, the first valuation price, right? So in this case, the proceed, which is basically the gain of the IPO, so the trade between what you are selling in equity, in shares, and what you are getting in cash, well, the proceeds from the old shares is 20 times 2, so 40. As you can see, I'm still not at my 50 here. These two guys are happy because they were able to sell 10 and 10, which was the original intention. So now that we are at this point, we see, okay, we were able to get 40 through our IPO, but we need in total 50 for our project. So we need 10 more, which means basically at the same price of $2, we need to sell 5 more new issued shares, which will lead to 5 shares times $2, $10. So in total here, and the result of this example here, as you can see, what we have learned is, of course, you need to know if you need cash or not, and of course you need to anticipate your realistic share price, and you need to know who is selling and who is keeping. And once all that stuff is finalized and you are going to the market for the first time, you are selling existing stuff for 40, you are selling new shares for 10, and the result of all this stuff is actually, first of all, how much equity has been sold. Well, we have said that the entire pie was made out of 100 shares, and we were able to sell 10 shares plus 10 shares, which means 20 out of 100. So the company sold 20 existing equity, to get 40 of cash. And as they were not able to finance the entire project through that, they decided, okay, we need new shares issued to the public, and in this case they issued 5% on top of what they already sold for 10. So this is basically the example. Now let's quickly look at the dilution to understand what happened and why it matters actually. Last factor, which is very important to understand when it comes to how much should I raise during an IPO, for example, is what is called dilution. So let me explain you during this example what dilution is. We went from a private company that went public to, of course, a publicly traded company, and a lot of things have changed. We have seen that the original private company had 100 shares valued at $1. 100 shares times $1 gives you the valuation of the company, which was a valuation of $100 for the entire company. We also have seen that when the company was private, the owner had 50%, and he wanted to keep 50 shares out of 100, so 50%, he wanted to keep everything. On the other side, we had our private equity and venture capitalists. They both had 25% or 25 shares in this case, and they both were able to sell 10 shares each. Okay, so a total of old shares that has been sold was 20. And plus, since the company needed more money, more fresh money, the company also decided to issue new shares, and they issued 5 new shares. So now let's look at what happened when when the company became public. Well, first of all, there are not 100 shares anymore, but 105. Why? Because we have the 100 shares from the pie here, plus the new issued shares, leads to 105. And we also have seen that the company was able, well, to double the stock price, basically from $1 when it was private to $2 when it was public, because investors were very bullish that the new company would be a great investment because of this famous project we are investing in, right? So now what happens to the valuation? And the valuation, as you can see, jumped from 100 to 210 for the entire business. So that's a great thing. Of course, the stock price doubled and the share price increased by 5 as well. The share numbers increased by 5. So now let's look at the percentages, because this is where the dilution is happening. And what you have to understand about dilution is it can be a factor when it comes to raising money during an IPO, because maybe the owner, for example, he had 50% before and he knows he's gonna have less than 50% but from a bigger cake. The problem with dilution is if you had 50, let's say 51% before, and you are dropping to 45, for example, you are losing control over the company, because a lot of things happen at 50 plus when it comes to voting rights. So this is very important, and that's why it plays a big role. But let's quickly look at the numbers. As you can see, my owner, he keeps his 50 shares, so 50 shares are still there. And my private equity and venture capitalists here, they have sold 10 shares each, so they are dropping from 25 shares each to 15 shares, okay? 25 minus 10. Of course, the public, so the new investors, the new hedge funds, the new banks, and all, you and me, all the public investors, they now have 25 shares. Why 25 shares? Because 10 shares from them, 10 shares from them, plus 5 new issued shares, okay? So now when we calculate the percentages, you will see that a lot of things have changed. Let's imagine the owner here, he had 50 shares, and you divide the 50 not by 100, but by 105, because that's the new number of shares for the entire company. So if you do 50 shares divided by 105 shares, you get 0.48, which means that the owner now owns 48% of the company. Before that he was owning 50%. So as you can see, there has been some dilution happening here. And this is what I was mentioning earlier, that sometimes here, as you can see, the owner drops from 50 to 48% without having sold shares, just because the pie got bigger. So of course he's losing some decision-making capabilities, of course. But of course for him it's a good operation from a business perspective, because he now, before that he owned 50% of 100, so which was a valuation of 50 million or $50. Now he owns 48% of 210, which is significantly higher than before, as you can see. So in this case, dilution makes a lot of sense. So in this video you have learned a ton of stuff. We have talked about a lot of things, such as dilution, and all the other factors I was talking about when it comes to raising money for an IPO. It's not a standard process. It's not like a company is going to the market and say we sell 50% of the shares, but it has to be backed by a story. It has to be backed by an investment of some kind. And why basically do you need money? That's the big question. Because if you want to transform all your fleet into autonomous cars, for example, of course you need a lot of money, you need a lot of investors who trust in you, and that's why basically the entire going public process can make sense for such a project, of course. So now that you know all that stuff, I wanted to tell you that I try to post high value content. I try to make it high value all the time, every Sunday. So corporate finance, market finance topics. Make sure to subscribe, of course, make sure to like, helps the algorithm, helps to spread the word to the world. Well, and the last thing I can say is basically enjoy your week, stay safe, stay smart, of course. See you soon, guys. Bye bye.